It's tax season, and you're probably not happy about the check you're writing to Uncle Sam because you made money in the market. Today, we're going to teach you how to invest in a way that's more tax efficient so you can keep more money in your pocket this year. In order to save money on taxes, you need to first understand some of the expensive landmines hidden in your investment portfolio. Any investment you own that throws off capital gains and dividends is going to be taxed.
Yeah, so let's take a look at active managers. So there's a lot of active management within 401ks and different investment accounts. And so the active manager, you're paying a fee which is usually higher than these index funds. And within that portfolio or the mutual fund, they are buying and selling on your behalf, and those taxes actually get pushed down to you. So the income and growth gets passed down to the investor. And so like Brad mentioned earlier, even if you didn't sell anything last year, you could have still got a 1099 in the mail and owed taxes.
Right, and I don't know why it works this way, but the tax code in the US is written so that ETFs don't have to pass on the tax bill to the investors the way actively managed mutual funds do. So for that reason alone, ETFs are way more tax efficient. They'll help you keep the tax bill lower. In addition, all that churning causes tax drag. It's kind of like driving a vehicle that's not very fuel efficient. So we all know that we need to save and invest for retirement in order to someday stop working. But let's put it this way. You can drive across country in a pickup truck or in a Tesla. And you're going to get to your destination in either one, but one is going to cost you a whole lot more money in gas than the other. And that's how it works with investing. The tax drag that comes with using inefficient investment vehicles like mutual funds can be akin to driving a gas guzzler.
Yeah, but those off-roading vehicles are pretty fun sometimes, right?
I know, we all love our pickup trucks.
Right, but seriously, we get the point here, and we see it all the time with the do-it-yourself investors and people with multiple 401ks. And as of right now, 401ks, you're stuck to those mutual funds on there, which is causing you excessive fees and the tax drag, like you're saying. And then also, you're being inefficient because now maybe your strategies are working against you in these different areas.
Right. So the investing world has evolved and gotten so much better since you first started investing. If you haven't updated your accounts, now's the time, and you should really use the more tax-efficient ETFs. Like mutual funds, ETFs still give you exposure to owning great companies of the world, which is going to help you grow and compound wealth over time. But they do so in a manner that's way more tax-efficient than mutual funds. The US tax code doesn't make ETFs throw off those capital gains, as I mentioned, but mutual funds do. So you get the point. So now that we've covered past and present of investing in mutual funds and ETFs, let's talk about the future of investing. No, I'm not talking about crypto, meme coins, or sports cards. I'm talking about direct indexing. So direct indexing gives you the ability to unwrap the ETF and own all of the securities inside of the ETF so that you can not only get the good returns of that index, but you can also tax loss harvest to lower your tax bill.
Yeah, and these are even more tax efficient than their ETFs. So think of the S&P 500 as a direct index that you can buy. And so you actually own all the individual holdings in here. So as opposed to that against the ETF, you could have the ETF S&P 500, but you have to sell that whole ETF in order to do any tax loss harvesting. So now going back to direct indexing, you can sell the individual holdings and have more efficient tax loss harvesting.
Right, and what's really cool is you can have a direct indexing strategy for your S&P 500. You can also do a small cap strategy using the Russell 2000. You can do an international strategy using the EFA, and then whatever asset classes are missing, you can use ETFs to fill in the blanks and build a really good portfolio that's also very tax efficient. If you want more information on direct indexing, take a look. We did a whole video on it. I think you'll like it. If direct indexing seems too advanced for you, let's quickly cover some other great tax efficient ways to invest. So if you ever find yourself in the 12% tax bracket and you've got some low basis stock with lots of gains in it, consider selling some of it tax-free. The 0% long-term capital gains bracket goes all the way up to $96,700 for married filing jointly and $48,250 if you're single.
Right, and then another thing you could look into is the specific dividends that you're looking at. So it's not as easy as just picking dividend stocks. Within there, you can either have qualified or non-qualified dividends, and non-qualified dividends is a fancy way of saying your ordinary income rate. So that could be tax inefficient if you have too many non-qualified dividends there. So the qualified, you'll just need to look under the hood a bit to make sure that you're satisfying a couple rules, but they're usually US stocks, and you've had to have held them for about 61 days. Otherwise, instead of getting the qualified dividends, which are 0%, 15, or 20%, which are usually more efficient than your ordinary income, you could be running into a landmine and causing ordinary income taxes.
Right.
And then another one, asset location. So putting your most tax efficient funds in taxable investment accounts and your tax inefficient funds in your IRAs or other qualified plans, because your bonds or your real estate are pumping out income, and that's taxed at ordinary income. So it'd be nice to just package that up in your IRA and not pay taxes along the way, and then keeping your stocks or individual holdings in the taxable account, your growth funds or anything like that aren't putting off these dividends or income.
Yeah, and if they are, it's usually qualified dividends, which is qualified at the lower capital gains rates.
So all of this is going to add to your tax alpha for the year and get more to your bottom line.
Now let's talk about something that's triple tax advantage, health savings accounts, or HSAs. We love these investments because not only do you get the deduction when you make the contribution, but it grows tax-free, and so long as money comes out to be used for qualified medical expenses, the distribution's tax-free. And while you're at it, consider making the contribution, investing in the HSA, letting it grow and compound, and then later on down the road when you have long-term care expenses, using a larger pool of money that's grown over the decades to come out tax-free and cover those long-term care costs.
Yeah, and while we're at it, let's not forget to max out the 401k. This could actually buy you the opportunity to be able to contribute to a Roth IRA as well. And although it's not giving you that tax deduction up front, they're growing tax-free in there, and all of those dollars are coming out tax-free in the future, and you're going to love those down the road.
Absolutely. And now let's round it out by talking about donor-advised funds, CRATs and CRUTs. And a donor-advised fund, or a DAF, is an investment vehicle that you make a contribution to and you get a tax deduction. You then invest and grow the money inside of the donor advised fund, and later on down the road you can choose the charity of your choice who you want to benefit with the money. And Matt, what's a CRAT and a CRUT?
Yeah, great question. So they're pretty similar in that they are annuities for creating income while you're alive and then leaving dollars to a qualified charity of your choice after you're no longer with us. And the difference is that the CRAT is an annuity paying you the same income each year as opposed to the CRUT that can change based on how the investments within the vehicle are doing. So the way that they work is that you set up an irrevocable trust for either of these, and you put a certain amount of dollars into these accounts, and it will create an income stream based upon a percentage that you want to pay out from it for up to 20 years. And then whatever's left over at the end is given to the charity. So nice way to give you a stream of income while you're here with us, and then leaving whatever's left over at the end.
And so where do you get the tax benefit? Is it up front or is it at the end?
So you're getting the tax benefit up front. So the dollars that are left at the end may be significantly less than the income that you got out of it and the tax deduction. So it's a beautiful thing if you've got all the working parts that make sense for you.
You've done your due diligence by investing intelligently and getting gains. Now, your silent business partner, the IRS, wants a cut of your success. They can only take what you let them have, so it's vital that you learn how to lessen their share by investing in the tax-efficient ways that we've just laid out.
And if you want to see where you can save money on taxes, use the link below and we'll give you a free tax analysis report.
Make sure to like and subscribe to the channel, share it with anyone who can benefit, and we'll see you on the next one.